Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Reserve Bank of India enables local banks to offer round-the-clock trading in the Indian rupee to curb the influence of offshore trading in the currency markets. The RBI also imposes threshold limits for asset quality, capital adequacy and profitability of urban cooperative banks in a bid to manage stress in the sector. Kerala-based ESAF Small Finance Bank has filed its draft papers with SEBI for its 976 crore initial public offering. And the Election Commission announces polling dates for Delhi and the National Capital Region. Voting will take place on the 8th of February and counting on the 11th. Well, let's take a look at the trade setup for the day. It looks a lot better than what it was looking like yesterday at close. The global setup is a lot more optimistic than what we were fearing would be the case today. Nevertheless, it is not done and dusted as yet. It's still a moving piece, but the US markets had an intraday recovery. The Dow recovered almost 200 points from the lows of the day to end about 0.25% higher. I don't think too many people anticipated this. Remember, when we shut shop for our markets, the Dow futures were trading down 0.66%, but there was an uptick for the S&P and the Dow intraday, and that was the highlight of the trading day yesterday. The pullback that we saw in the S&P and the Dow in trade yesterday, which is essentially the reason why the rest of the markets are also doing well. So Asia as a pocket, and Hong Kong, Shanghai, Kospi, Nikkei, the Australian indices, all of these have a green tick to them to the marks. And mind you, the SGX Nifty, by the way, speaks of a start which is 0.5% higher. Keep in mind that Europe ended negative yesterday, and because of the global mood turning up, Europe will start off positively today. So that will probably add to that little bit of flavor if indeed we manage to hold on to these gains. Now, to my mind, the risk of sentiment is ebbing, and the global market mood might just reflect on the beaten down stocks today. But I do think that the large cap blue chip names, which haven't had bad news but corrected yesterday because of the sentiment, the likes of Bajaj Finance or HDFC Bank, which has come on with a stellar quarterly update, and I'll talk about that in a bit. These are the companies that could actually lead the rebound today. So the Bank Nifty corrected quite viciously in trade. Financials were down. I think they could well be at the forefront of the move today. The only intriguing part to my mind is what happened in trade in terms of flows. Yesterday you saw the net flows were hardly anything to write home about. 103 crores for FIIs, DIs about 23 crores. The question that begs is, were intraday traders and HNIs at the forefront of the trading activity yesterday, and could the SEBI rules have anything to do with it? Now, I really don't know. We'll have to speak to brokerages to talk about this. But yesterday the numbers were just so low on the trading front that you got to ask this question, that could that be one of the reasons as well? Because the trading activity from the institutions was clearly very, very low. But we're not complaining because the morning looks a bit more sane in the session today. Let's see. But as I said, it's a moving piece, and therefore a lot of things could change. Crude prices, by the way, have come off, and that should also augur well. I think the last I checked, crude prices are hovering around 68.5 odd dollars per barrel. So they've cooled off from the 70 mark, which is actually a good sign. What are the stocks that one should monitor in light of this in the session today? HDFC Bank, I think just the stellar number that the bank has posted in this Q3 updates. The update shows strong growth in loans and deposits, and the bank continues to gain market share at a very accelerated pace. Just the quantum of deposit growth that has come in for HDFC Bank seems to suggest that most people have had the flight to safety, and they've gone out and put in open accounts or put in more deposits with HDFC Bank. It should only augur well. Low cost deposits, the market is theirs to trade in or do business in. I think the street will take these numbers positively. Let's wait and watch. PI Industries is an interesting one. There's a factory accident that happened in one section of the multi-product plant in Gujarat. The other operations of the plants have not been affected on the site, but this is a critical plant, and brokerage view have been divided. So BNK, for example, says it's one of the key units for exports, and therefore the news is negative. There is another brokerage, MK, which is saying that you should go out and maybe buy this. So it's an interesting one to monitor in the session today. Let's wait and watch what happens to PI Industries. If there is a pullback, maybe it gets bought into. ITI is the other interesting one. The revenues are up 47%. Net profit is up 12.4 times. That's quite a stunning performance. EBITDA gain at about 64 crores versus an EBITDA loss. Though you would have to keep in mind that auditors have said that the profit has been overstated by 19 crores. Not a very large sum of profit that has been overstated understated according to auditors. But the stock could have a positive reaction in the session today. Last but not the least, Aster DM Healthcare, we're going to consider a share buyback on January 9th, so do watch out for that. And lastly, I just want to end this with a small note that is coming from Goldman Sachs on oil and gold. They say, and I quote, this is a global note that has been put out, the range of potential scenarios is very large, spanning oil supply shocks or even oil demand destruction, which could be negative to oil prices. In contrast, history has shown that under most outcomes, gold will likely rally to well beyond the current levels. So maybe, just maybe, gold is the space that most people believe should bet on. Goldman Sachs certainly believes so. 1558 to a tri-ounce for the dollar. Anyways, having said that, that's the entire synopsis. And as we said, crude has actually cooled off. It should augur positively for markets. Let's wait and watch if that happens. Let's tell you what's lined up on First Word today. Sophie Kamaruddin tells us what brokerages are making of the recent spike witnessed in gold and crude prices. And we speak to Arvind Sanger about Indian equities, which took a knock in trade yesterday, as well as the geopolitical stress. Shefali talks about credit access grameen and how its stock price outpaced peers in 2019. And Forum fills us in on what's forced general insurers to move beyond automobiles. Gold is living up to its reputation of being a safe hedge against equities. The precious metal is trading at its highest level since 2013. Crude, in the meantime, is also trading at multi-month highs, even though it's cooled off a little bit in trade yesterday as investors weigh the possibility of sharp drop in supply. The recent spike has prompted brokerages to choose between oil and gold, as I told you as well. Sophie Kamaruddin of Bloomberg News files this report.
First, a look at oil markets. We have prices retracing some of the events that we saw on Monday, but staying elevated after jumping more than 5% since last week's U.S. airstrike on Baghdad. Brent staying above $68 a barrel. But Goldman saying that the price risk skewed to the downside unless there is a major supply disruption, which Asian oil buyers are closely watching, given that the threat could expand beyond Saudi to Iraq, Kuwait, and UAE, which make up about 68% of total OPEC production. Yet even if tensions do escalate, Goldman expects that bullion will prove the better hedge than oil. UBS and JP Morgan also seeing more room to run for gold at 1,600 or higher, but ABN AMRO in the camp that will see gold prices stalling as liquidity returns from the holidays. And as you can see on the chart right here, the rally for gold looking overdone, with a 14-day RSI approaching the most overbought levels since 1999. This after gold hit a 2013 high, and we had futures closing a 9-day winning streak. But the options market anticipating more gains for gold as volatility for bullion jumped to the highest level since mid-October.
Well, the Indian markets also dropped almost 2% in trade yesterday as the US-Iran tensions flare up. I think it's very important to put all of this into perspective. What could happen to crude and the resultant impact on oil importers like India, and how would India fray in the current setup of what's happening in a volatile world? To put all of that into perspective, Arvind Sanger, managing partner at Geosphere Capital Management, joins us right now on the phone. Arvind, good having you. Thanks so much for joining in, and best wishes for a happy 2020. Though it has not started off in exactly the happiest of fashion, geopolitical tensions, and that will weigh in on sentiment, I think.
Yes, thank you for your wishes, and I wish you and your listeners and viewers the same. And yes, it has been a somewhat rude start to the year. And, I think that there is obviously some rise in geopolitical tension. The hope that I guess we can have as an optimist perspective is that President Trump is, saber rattling. But at the end, he is very sensitive about economic growth. This is election year for him, and I think it's important for him not to derail the U.S. Or global economies. And therefore, my sense would be that there will be attempts to ratchet back tension. But right now, the problem with the kind of war-like noises emanating from both sides is there is risk of miscalculation, and clearly the Iranians are going to have to respond, and so the risk of miscalculation is one where things could go out of control, and that is going to be one of the near-term headwinds to the market is this uncertainty about what Iran is going to do and how this is going to play out.
Yeah, Arvind, that was going to be my next question. While the markets are a bit sanguine because the US market shrugging off these nervousness yesterday, this doesn't seem to be a done deal as yet. And therefore, do you think any kind of these upsides that the markets seem to be in the mood of might be restricted? Because if indeed any noises that have come in from Iraq and Iran are any indication, this will not probably end as soon as the equity markets yesterday seem to believe.
Well, so, the economic fundamentals are looking better. The central bankers are supportive. The Fed is clearly on a, easy path, if not an easing further. So, the economic backdrop after a mini slowdown that we saw last year seems to be on a revival mode. So I think what the market is betting on and hoping for is that anything that happens in terms of additional flare-up in the Middle East will not be too damaging to oil prices. And if there is not too much of an impact on oil prices, then the other factors that drive economic growth, including a China deal that is being signed, are all favorable. And so, one can make a bull case, but I think, from a near-term perspective, our sense is to be a little bit prudent and a little bit opportunistic to look for pullbacks to get more aggressive, given that markets are already at, all-time highs or very close to all-time highs. Therefore, a lot of good news is priced in.
Yeah, and opinions vary, of course, but I mean, my one more question would be on what does all of this do to the Indian situation as well. It's well known that if crude prices were to spike, India would have a problem. But looking at the current circumstances and looking at the valuations and the fact that we are in a month wherein the earnings season is expected to be positive and we are in the lead up to the budget, how do you think the Indian markets would behave?
Well, I think the Indian markets, obviously the Nifty is, very close to its all-time high. And, the P's are high enough that a lot of good news in terms of recovery is being discounted. Obviously, this quarter should show some very moderate improvement over the previous quarter. But I don't think the market is at valuations where this quarter is sufficient. What we really need is a meaningful economic rebound from extremely weak, last several quarters. And for that, I think, we need to see business confidence come back, and oil prices could certainly play a spoiler. But if oil stays, at or below $70, I think it will not derail the Indian economic outlook, which should recover from that deep dive that it saw in calendar 2019. But I think, fiscal 21 is a year that we are counting on. And you mentioned the budget. The budget is going to be helpful given how fragile economic confidence in India is and how weak both, business capex and even consumption spending has been. I'm hoping that the government will take some steps to try to revive that.
Okay, one final question, Arvind, and I'm not asking for a stock-specific view out here, but oil naturally brings the oil marketing companies in focus. Add to that, the BPCL divestment is on hold, at least for the current financial year. May happen in April if some media reports are to be believed. But this has bearing on the whole divestment mood around India as well. What do you make of that company or that space in light of both the divestment announcement and the fact that oil is as volatile as it is right now?
Well, so, at the end of the day, the refining companies, refining and marketing companies like BPCL, and IOCL and others are not really beneficiaries of higher oil prices. They're actually beneficiaries of lower oil prices so that demand remains strong. So therefore, I think from a, marketing of BPCL as a privatization candidate, I think the oil price volatility near term is not going to be a big factor, but higher oil prices are not necessarily, although BPCL does have some upstream businesses, but it's not necessarily. my assumption is that it will not have a big impact on that. As far as Indian equity markets are concerned, there is not much of ways to think of companies that benefit from higher oil prices. The refining and marketing companies generally, are not beneficiaries of those higher prices.
Yeah, they aren't. But Arvind Sanger, take a moment to thank you for joining in today and giving us your perspective. Really appreciate your time this morning.
Okay, thanks.
That's the view from Arvind Sanger of Geosphere Capital on oil, on the risk of or pullback that we may see. He doesn't believe that there is a chance of a pullback in India because a lot of positives already been priced in and higher oil prices may only continue to weigh in. Let's wait and watch. For now, for today's session, things may be different. Let's see how they pan out over the next few days. We'll take it a day at a time, really. These things are moving at a very fast clip on the geopolitical front. Move back to India and a couple of micro pockets. When credit access grameen hit the primary market in August 2018, analysts had suggested avoiding the issue due to its geographical concentration in Karnataka and Maharashtra. But investors have lapped up the stock in the secondary market. It's in fact doubled in 2019. So what's working for the microfinancer? Has something changed? Shefali Malik is standing by to tell us that. Shefali, good morning.
Hi, good morning. First of all, to start with, it has given stellar returns ever since it's listed, about 78%. And, I went back to the IPO notes. Most of them had, including some of the most credible analysts, had actually said avoid because of the geographical concentration that it has in two states, Karnataka and Maharashtra. Ever since then, it has given 78% returns. In 2019, it was one of the best performing NBFCs. Among NBFCs, it had about 100% return. So it was a top two actually. Amongst NBFC MFIs, it was obviously the top performer. In comparison, Satin Credit Care, Ujjivan, etc. All these, most of these gave negative returns in 2019. And there's one player, Spandana Sphurti, that got listed in 2019 itself. With that, the comparison is a bit closer. Since Spandana's listing, Spandana gave 40% returns and Credit Access has given 51% returns, and the performance of the others have been mixed since then. That is August 2019. So that's about the share price performance, about what is really working for them. So basically, instead of so one of the biggest concerns among the MFI players is the geographical concentration always, because we know already what happened to Andhra Pradesh a couple of years back when there were regulatory changes, and always they're prone to risks such as natural calamities, political risks, etc., regulatory concerns. That's always there, that if the margins get capped further at any point of time. So that's always a risk. But instead of focusing on the state diversification, what the company actually did was they actually focused on districts. So they went district by district and nurtured those districts, and that's the strategy that they took. So they had declining concentration in terms of the district. So if you actually see in percentage of AUMs, the ones which contribute to less than 0.5% has been increasing from 65 to 77 now, and the ones which contribute more than 5%, those number of districts have actually come down to nil. So in that sense, the contribution is getting more and more granular from each individual district. Aside of that, if we look at the financial performance, their AUMs have grown at about 44% in FY19, and the last 5 year CAGR has been 49%, and the profit has grown by about 35% in the second half of this financial year versus about 60% over last 60% CAGR over last 4-5 financial years. And in addition to that, their margins have also been holding up. It's a given that's what the management told me, that it's around 12% and would continue to stay around that. Their gross NPAs have also come down from 0.8% at the time of Q4 FY18. I'm taking that particular quarter because after that they listed, so just as a comparable. And now at the end of the second quarter, it's 0.5%, so barely minimal, and net NPAs are almost nil. And if we look at their cost to income ratio, so instead of, even though they're going district district by district, so that means that they would have more executives to look after those districts. But despite that, their cost to income ratio has been coming down. From in FY15 it was about 46%, and now it's about 39.8%. So consistently it has been coming down because of the higher concentration on the districts. They've actually been able to retain their customers, and hence the cost to income ratio has been coming down. Now what's been working for them? So the strategy that they actually took was that they actually nuanced their operations into many smaller processes. So they have a differentiated business model. So this is as per many analysts, the analysts who have covered the stock. I have spoken to some of them, and according to them, the biggest differentiator is the weekly meetings that they conduct, whereas most of the other MFIs and the players who are now getting into it, some of the MFIs, some of the banks, they have a model of conducting monthly meetings. So that is a big differentiator. So that helps in deeper engagement with the customers, and that helps in maintaining the asset quality as well. And they have different credit limits for each borrower within a particular group. Aside of that, they provide a flexible repayment facility to to all of their borrowers. So the borrowers can choose when they decide to pay weekly, fortnightly or monthly. So that also helps. And they have a multiple product approach as well. Within the credit limit that they provide to a particular borrower, they actually offer multiple other products as well, such as festive loan, etc. And many other MFIs are really not doing that. So this is a very differentiated approach that they've taken. And once they grow in one particular district, then they go to the next adjoining district. So that's what their approach is. Other than that, so they recently acquired Madura Finance also, which has AUMs of about 2,100 crores. So that will reduce the geographical concentration, also bring down state concerns as well.
Okay, Shefali, what did the management have to say in the conversation with us earlier? What are they guiding for in the near future?
Well, yes, I did speak to the management about what are their plans. So the management thinks that the AUMs will continue to grow at about 35 to 40%, as there is huge potential in the MFI business, specifically in the rural areas. And they would continue to remain focused on rural. They don't have plans to get into other businesses such as SME, which many other MFI players are doing. And they plan to continue to add about 30 to 40 districts per annum. And remember, one of the strongest points for them is that they have an international promoter, so which has been helping them in getting international funding, and that share will go up to about 30 to 40% in 2 years versus 20% currently. And they do need to bring down the promoter shareholding as well in about 1.5% to meet the regulatory requirement. So they would be fastening the process of fundraising, and the discussions for the same would actually start in the second half of FY21.
Okay, Shefali, thanks so much for putting that into perspective. And viewers, as I always say, that most of the things that we speak about on First Word, some pieces around them would be there on our website, so do try and log in and read more about these as well. Well, from moving on from microfinanciers to some other businesses, the demand slowdown in the Indian economy has put the dominant line of business under pressure for general insurance businesses. Falling automobile sales mean there are fewer takers for motor insurance. Forum Bhatt is standing by to tell us how the insurance companies are dealing with the situation. It's something that they may not have faced in the recent past, Forum. What is it that they are doing?
Yeah, so Neeraj, well, the slowdown in the auto sector has impacted the general insurers as well. So the motor line of business is one of the dominant line of businesses for the insurers. So the lower auto sales has led to the muted premium growth for these players. We also spoke to a few of the companies, and so many players expect the revival to happen only over the longer period of time. ICICI Lombard sees a revival in the motor business over the longer term. SBI General expects market demand for motors to remain tepid for another 2 to 3 quarters. According to Future Generali, the government's focus towards demand growth should pull up the demand in only couple of years. So with this, in the current scenario, a lot of insurers are now focusing more on the non-motor business. So even if we look at the gross direct premium trends for the industry, the non-motor segment has registered a double-digit growth up till November 2019. seen, while the growth for motor segment remained muted at about 9%. Now looking at few of the larger players, the largest player, New India Assurance, the net earned premium for the player grew the most in non-motor segment for the first half of this year. The highest growth was seen from the motor business for the company, while the motor segment saw a degrowth of 1% for New India Assurance. Coming to the largest private player, ICICI Lombard, the net earned premium again for the non-motor segment registered a significant growth in comparison to the motor business. So moving on to what the focus area is for these players now, ICICI Lombard foresees growth from health, property and casualty segments going forward. SBI General sees growth in the retail segment to happen from the health and personal accident products. Fire and liability business being the focus in the corporate segment for the company. Future Generali has taken special initiatives for the robust growth in the retail health business. While a lot of players are focusing on the non-motor business, the product mix for the industry is largely changing now. So the gap between the motor and the non-motor business is narrowing down for the players now. So going forward, it is expected that health insurance will drive the growth for these insurers. So we spoke to a couple of players, and here's to what they have to say. ICICI Lombard sees growth in the health insurance to be higher than the motor segment. SBI General expects the company's health portfolio to grow at about 39% this fiscal. Future Generali believes that the overall health insurance will see a 16 to 17% CAGR over 3 to 5 years going forward.
Okay, Forum, thanks so much for putting that into perspective. And I think that point which shows how the growth in the non-motor space has gone up is very interesting. It's in part not a conscious decision, but because motor sales have slowed down, and therefore the companies have had to go out and look at other options for them, I guess. Yeah,
and so also one of the intent of the companies is to create a balance between the product mix. So right now, if you see, the motor is one of the dominant line of businesses. So they want to narrow the gap between the motor and the non-motor businesses. So that is also one of the reasons why they are aggressively focusing on the non-motor counterpart now.
Okay, great. Thanks so much, Forum, for putting that into perspective. And again, you can go out on our website and try and read about this piece as well. That's all that we have on First Word today. But lots more lined up on Indian Open. Has foreign investor sentiment soured on Indian markets? And what happens in this current slowdown, seeming slowdown? Sameer Arora of Helios Capital weighs in on that. We get a sense of the consumer demand in the country with Sameer Shah of Godrej Consumer Products. But after this break, a full tilt towards the day's trade.